Hey everyone, welcome to a deep dive into the mind of Warren Buffett.
Ooh, Warren Buffett.
We're going to be exploring excerpts from the Warren Buffett way
Okay.
to try to understand how he's achieved such incredible success as an investor.
Yeah, and one of the things that I find most interesting about Buffett is that it's not about, magic formulas or risky bets.
Right.
His approach is actually really rooted in principles.
Hmm.
And those principles have guided him through all sorts of different market conditions, whether it was a bubble,
Yeah.
a crash, you name it.
Yeah, that's really different from a lot of investors who are kind of always chasing the next hot stock.
Yeah.
Buffett seems to be playing a different game entirely, like he's a marathon runner
He is.
and not a sprinter.
Exactly. He's playing the long game.
Yeah.
Not interested in those quick wins, but just focused on building wealth steadily over time by owning pieces of great businesses.
Hmm.
And that brings us to something else that's fascinating about him is the impact of his mentors. You know how they say you can learn a lot about someone by the company they keep?
Mm-hmm.
Well, Buffett's mentors were giants in the investment world.
I'm curious about that. Who were these mentors that had such a profound impact on Buffett's journey? What did he learn from these giants in the investment world?
Well, there are three who really stand out. First, you have Benjamin Graham,
Sure.
who is known as the father of value investing.
Hmm.
He's the one who introduced Buffett to the concept of margin of safety.
Okay.
Think of it like this. You're buying $1, but you're only paying 50 cents for it.
Right.
You're building in a cushion
Hmm.
just in case your calculations are off.
That makes a lot of sense. So it's not just about finding a good deal.
Oh,
It's
yeah.
about finding a great deal with that extra layer of protection built in.
Precisely.
Yeah.
And one of the best examples of this in action is how Buffett approached American Express back in the 1960s.
Okay.
There was a scandal that hit the company, and the stock price just plummeted.
Mm-hmm.
Most investors were running for the hills, but Buffett saw an opportunity.
He did.
He recognized the underlying strength of the business,
Mm.
and he scooped up shares at a steep discount.
Wow, that was a pretty bold move at the time. But it wasn't all about number crunching, was it?
No.
He also looked beyond just the balance sheet, right?
You're absolutely right, and that's where his second major influence, Philip Fisher, comes into play.
Okay.
Fisher emphasized the importance of qualitative factors, things like a company's management quality
Okay.
and its potential for growth over the long term.
So more than just the numbers, it's about the people at the helm and their vision for the future of that company.
Exactly.
Yeah.
One of Fisher's methods that I always found particularly interesting was what he called the scuttlebutt approach.
Scuttlebutt.
Yeah, it's essentially about gathering information from various sources like competitors,
Okay.
suppliers,
Hmm.
customers, really anyone who can shed light on the real story behind a company.
Oh, so almost like a detective gathering clues
Precisely.
to piece together a bigger picture.
Now, the third influential figure in Buffett's life was John Burr Williams,
Okay.
and he developed a model for valuing companies based on their future dividend payments.
Dividends. Those sweet rewards of owning a piece of a profitable company.
Indeed, and that idea really resonates with Buffett's focus on a company's ability to generate cash flow.
Yeah.
He's not just looking at profits on paper, but companies that can actually put money back in their owners' pockets.
That's a good point. And that brings us to another key aspect of Buffett's approach, and that is focus investing.
Right.
He's not about spreading his bets all over the place, is he?
Not at all.
Yeah.
Buffett believes in concentrating his investments in a small number of companies that he understands deeply.
Mm-hmm.
This is very different from the diversified portfolio approach that many financial advisors recommend.
Right. And he has some pretty famous examples of these concentrated holdings, right?
It does.
Companies like Coca-Cola, Gillette, Wells Fargo.
Yeah.
These are household names that he's held for years and years.
Yeah. Exactly. By limiting his holdings, he can truly immerse himself in each business.
Right.
He's not just buying stocks. He's essentially becoming a partner in these companies.
Yeah.
And this allows him to develop a much deeper understanding of their operations, their challenges, their long-term potential. And that brings us to the heart of Buffett's approach, which is how he evaluates businesses before even considering an investment.
Okay, so let's get into that.
Yeah.
What are some of the things that Buffett looks for when he's sizing up a company?
Yeah.
What sets the stage for him to even think about making an investment?
Well, he looks at several key areas.
Okay.
The business itself, the management team running the show,
Mhm.
and of course the financials. Think of it like a three-legged stool. Each leg needs to be solid
Yeah.
for the whole thing to stand up.
Okay, so let's start with the business itself then. What
Yeah.
catches Buffett's eye? What kind of companies is he drawn to?
One of the first things he looks for is a consistent operating history.
Okay,
He wants to see a track record of
R-
profitability, not just a one-hit wonder.
right,
Companies like Coca-Cola
right.
that have been consistently delivering for decades are a perfect example of what he likes.
It makes sense. So it's about looking for companies that have proven they can navigate different economic conditions and still come out on top.
Right.
But it's not just about the past, is it?
Right. He's also looking ahead, trying to assess the company's long-term prospects.
Okay.
One of the things he looks for is a moat,
A moat.
a sustainable competitive advantage.
Mm-hmm.
Think of it as a barrier
Okay.
that protects the company from its rivals.
I like that analogy,
Yeah.
a moat. It really does paint a picture of a company that is well defended.
Exactly.
Yeah.
A good example of a company with a strong moat is Larson Jewell, which is a picture framing company that Buffett acquired.
Okay.
They're the wholesale supplier of custom picture framing materials.
Mhm.
And, they've built a reputation for outstanding customer service.
Okay.
They go above and beyond for their customers, offering things like same-day delivery, even for small orders.
Wow, so they found a way to differentiate themselves in what might seem like a pretty basic industry.
Exactly. Now, on the flip side, there are types of businesses that Buffett tends to avoid.
Okay.
He's generally wary of commodity businesses.
Because the prices of commodities can fluctuate so wildly.
That's right.
It's hard to predict what will happen.
Commodity businesses are often at the mercy of factors beyond your control.
Right.
Even Berkshire Hathaway's own textile division struggled because of this inherent volatility in the textile industry. It's like, imagine trying to build a house on shifting sand.
Yeah.
It's really hard to create a stable foundation when the ground is constantly moving beneath you.
That's a great analogy.
Yeah.
I get it. But wait a minute. Didn't Buffett acquire McLean Company,
Yes.
which distributes groceries?
Yes.
That's a commodity business.
Ah, you're sharp.
Yeah.
Yes, McLean does operate in a commodity-driven industry. However,
Oh.
Buffett saw something special in McLean.
Mm.
They were incredibly efficient.
Okay.
They were the low-cost provider, which gave them a real edge in that competitive market.
So it seems like he's not completely ruling out commodity businesses, but he's looking for those exceptional players.
That's right.
Who can defy the odds.
He's looking for the ones who figured out how to navigate those choppy waters and come out ahead.
Right. Okay, so now let's move on to the next leg of that stool,
Okay.
the management team. So what kind of qualities does Buffett look for in the people running the companies he invests in?
Well, Buffett has three main things he looks for in management:
Okay.
rationality,
Okay.
candor,
Mm-hmm.
and a keen focus on what he calls owner earnings.
Okay, let's break those down,
Yeah.
starting with rationality. What does that look like in the context of running a business?
For Buffett, a rational manager is someone who makes clear-headed decisions
Okay.
based on logic and reason, not emotions or trends.
Right.
They avoid what he calls the institutional imperative, which is the tendency to blindly follow what everyone else in the industry is doing, even when it might not be the best course of action.
It's like having the courage to go your own way, even when everyone else is telling you to follow the crowd. Can you give us an example of a manager who really embodied this kind of rational thinking?
Sure. One great example is Roberto Goizueta,
Okay.
the former CEO of Coca-Cola.
Right.
When he took over, he made some bold decisions to streamline the company, focusing on its core strength, the syrup business.
Mhm.
He sold off underperforming assets
Okay.
and resisted the urge to diversify into unrelated industries, which ultimately propelled Coca-Cola to new heights.
So it was about having the discipline to stick to what they did best and not get distracted by the shiny object.
Exactly. Now, the next quality Buffett looks for is candor.
Okay.
He admires managers who are transparent and honest with shareholders.
So being upfront about the good and the bad, not trying to sugarcoat things.
Precisely. And Buffett himself embodies this quality. He's famously open about his own mistakes.
Right.
Remember the General Re deal?
Oh, right. The reinsurance company that caused some headaches for Berkshire.
That's the one Buffett freely admitted that he misjudged the situation and was too slow to address some of the issues at General Re. It was a refreshing display of accountability, something we don't always see in the corporate world.
So it's about owning your mistakes even when it's tough and leading by example.
Absolutely. Now, the third quality Buffett looks for in management is a focus on owner earnings.
Owner earnings.
Yeah.
What exactly are owner earnings? It sounds pretty straightforward, but I'm guessing it's a bit more nuanced than that.
You're right. It's about understanding the true profitability of a business.
Okay.
Buffett defines owner earnings as the cash flow that a business can generate for its owners,
Mm-hmm.
after accounting for essential capital expenditures.
Okay.
It's a more realistic measure of a company's financial health than just looking at reported earnings,
Right.
which can sometimes be manipulated.
So it's about cutting through the accounting jargon and getting to the heart of how much cash the business is actually generating.
Precisely, think of it like this. You wouldn't judge a bakery solely on the number of cakes it bakes, right?
Right.
You'd also want to know how much flour, sugar, and other ingredients it has on hand,
Right.
how much it costs to run the ovens, and so on.
Yeah.
Those are the essential expenses that go into producing those cakes.
So owner earnings are like the bakery's net profit after you factor in all the costs of doing business.
Exactly. And that's why Buffett is skeptical of relying solely on reported earnings
Yeah.
or cash flow statements. He wants to understand the true earning power of a business.
Right.
And owner earnings provide a clearer picture.
Okay, that makes sense. So we've covered the first two legs of the stool,
Yeah.
the business itself,
Right.
the management team. What about the third leg, the financials?
Hmm.
What does Buffett focus on when evaluating a company's financial strength?
Well, his main focus is on determining the company's intrinsic value,
Okay.
what the business is truly worth based on its ability to generate cash flow over the long term.
So he's trying to look into the future and figure out what a company will be worth down the road.
That's exactly right.
Wow.
He uses a method called discounted cash flow analysis, which involves projecting a company's future cash flows and then discounting them back to their present value.
Okay, I can see how that could get pretty complex.
Yeah.
Can you give us a simplified example of how Buffett might apply this to a specific company?
Sure, let's take Coca-Cola,
Okay.
one of his most famous investments.
Yeah.
He'd start by looking at Coke's historical financial performance, paying close attention to its revenue growth,
Okay.
its profit margins,
Mm-hmm.
and its capital expenditures.
Okay.
Then he'd make some educated guesses about how these factors might evolve over the next 10 years or so.
Right.
He'd consider things like Coke's competitive position, trends in the beverage industry,
Huh.
and overall economic conditions.
So it's like a mix of art and science.
Exactly.
Yeah.
Then he'd take those projected cash flows and discount them back to their present value using a discount rate that reflects the time value of money
Right.
and the inherent risks of the business. Basically, this means adjusting those future earnings to account for the fact that $1 today is worth more than $1 tomorrow.
Yeah, it sounds like he's trying to figure out what those future earnings are worth in today's dollars.
You got it. Now, here's the crucial part. Buffett only buys stocks when they're trading at a significant discount to his calculated intrinsic value. This is his margin of safety in action,
Right.
making sure that even if his projections are a bit off,
Yeah.
he's still getting a good deal.
So it's like buying $1 for 50 cents.
Exactly.
Just like with that margin of safety concept we talked about earlier.
Precisely. He's looking for that extra layer of protection
Yeah.
to minimize his risk.
Okay.
Now, while Buffett is famous for his stock investments,
Right.
he's not afraid to venture into the world of bonds either.
Bonds, those are a bit different from stocks, right?
They are.
They're more about lending money than owning a piece of a company.
That's right. But here's the interesting part. Buffett approaches bonds with the same mindset he applies to stocks. He analyzes the issuing company's management, their financial health,
Right.
their long-term prospects. He's not just looking at the yield. He's treating the bond as a representation of a business.
So whether it's stocks or bonds, he's always thinking like a business owner,
Yes.
looking for value,
Yes.
minimizing risk. It's a consistent approach that has clearly served him well.
It certainly has, and it highlights another fascinating aspect of Buffett's philosophy.
Okay.
His understanding of market psychology.
Okay, now that sounds intriguing. We all know markets can be irrational,
They can.
driven by fear and greed. How does Buffett navigate those emotional currents?
Buffett famously compares the market to a manic depressive.
Okay.
Swinging wildly between bouts of euphoria and despair, his advice, tune out that short-term noise and stay focused on the long-term fundamentals of the businesses you own.
Easier said than done
You bet.
when the market is in a frenzy.
But Buffett has a remarkable ability to keep his cool. He understands that fear and greed can lead investors to make impulsive decisions, buying high and selling low.
So he's like the calm in the eye of the storm.
Yeah,
you know,
precisely.
while everyone else is getting swept up in the chaos.
He sees those moments of panic and exuberance as opportunities.
Mm,
He buys when others are fearful,
right.
and he sells when others get greedy.
Mm.
It's a contrarian approach that takes a lot of discipline.
That brings up something I've been wondering about this whole time. Buffett's approach to managing his portfolio. It's not like he's constantly buying and selling, chasing the latest trends, is he?
Not at all.
Yeah.
Remember how we talked about him playing the long game?
Right.
That applies to his portfolio management as well.
Okay.
He's not about racking up transaction costs.
Right.
You know those pesky fees that you pay every time you buy or sell a stock?
Oh, right. Transaction costs. Those can really eat into your returns if you're not careful.
They sure can.
Yeah.
Buffett minimizes those costs by holding on to his winners for years, sometimes even decades.
Wow.
This allows him to maximize the benefits of compounding.
Okay.
The idea that your returns generate even more returns over time.
Right.
Like a snowball rolling downhill, gathering more snow as it goes.
I love that snowball analogy.
Yeah,
It really illustrates the power of letting your investments just grow undisturbed over time.
exactly. It's like planting a tree
Right.
and letting it grow into a mighty oak. You
Yeah.
don't dig it up every few months to see how the roots are doing, do you?
Definitely not.
You let it take root and flourish.
So Buffett's approach is all about patience and letting those investments compound over the long term. But this seems to go against the grain of what a lot of financial experts preach, like diversifying across dozens or even hundreds of stocks.
It does.
Yeah.
And it goes back to one of his core beliefs,
Okay.
which is it's better to own a few outstanding businesses
Yeah.
than a large number of average ones.
Mhm.
He's not afraid to put a sizable chunk of his portfolio into the companies he believes in most strongly.
Right.
It's like having a small team of star players
Okay.
versus a huge team of mediocre ones.
So it's about focusing your energy and your resources on the investments that you believe have the greatest potential,
Exactly.
rather than trying to spread yourself too thin.
But that brings up an important point.
Okay.
Even for someone like Buffett, who has dedicated his life to studying businesses,
Right.
it can't be easy to stay objective all the time, right? I mean,
Yeah, okay.
we're all human and we all have biases
Think
that
so.
can influence our decisions.
Yeah, that's so true. We all have our blind spots, even the most successful investors.
Exactly.
But what are some of the psychological traps that Buffett warns against, the things that can trip us up even when we think we're being rational?
Well, one of the most common traps is what's called overconfidence bias.
Overconfidence bias.
Yeah, the tendency to overestimate our abilities and our knowledge. It can lead us to make impulsive decisions
Right.
without fully considering the risks involved.
Yeah.
It's like thinking you're a better driver than you actually are,
Ouch. Yeah.
which can lead to some pretty dangerous situations.
We've all seen those drivers on the road.
We have, and this bias can be amplified
Okay.
when things are going well.
Mhm.
When we're on a winning streak, it's easy to start thinking we can do no wrong.
Right.
But Buffett reminds us that even the best investors make mistakes.
So it's about staying humble
Yes,
and recognizing that we don't have all the answers.
exactly. The key is to learn from those mistakes
Right.
and keep refining our approach.
Yeah.
Now, another common psychological pitfall is what's called anchoring bias.
Anchoring bias.
Yeah, this is the tendency to get fixated on a particular piece of information, often the price we paid for a stock,
Right.
and let that influence our future decisions,
Okay.
even when the fundamentals of the business might have changed.
So even if the company isn't performing well, we might hold on to the stock just because we don't want to admit we bought it at a higher price.
Exactly. We become emotionally attached to that anchor price, and it clouds our judgment.
Yeah.
But Buffett is ruthless in cutting his losses when he realizes he's made a mistake.
Okay.
He doesn't let emotions get in the way of making sound investment decisions.
So it's like ripping off a Band-Aid.
Exactly.
Sometimes it's better to just get it over with, even if it stings a bit.
That's a great way to put it.
Yeah.
And this leads us to another psychological factor that Buffett has mastered:
Okay.
handling market volatility.
Right.
Markets can swing wildly from day to day, driven by everything from news headlines to economic data
Right.
to just plain old speculation.
It can feel like a roller coaster sometimes,
It can.
especially for those of us who are newer to investing.
Mhm.
So how does Buffett stay grounded amidst all that chaos?
He has this great quote: "The stock market is a device for transferring money from the impatient to the patient." He understands that markets are inherently unpredictable in the short term,
Right.
but over the long run,
Yeah.
the value of a good business will eventually be reflected in its stock price.
So it's about having the patience to ride out those inevitable market storms and not panic when things get rough.
Exactly. Buffett sees market downturns as opportunities to buy great businesses at bargain prices.
Hmm.
He's not afraid to go against the crowd when he sees value that others are overlooking.
It's like that classic saying, be fearful when others are greedy and greedy when others are fearful. But that takes a lot of courage and conviction, doesn't it?
It does. But remember, Buffett isn't just blindly buying when the market drops. It
Right.
goes back to what we discussed earlier, the importance of thorough research
Yeah.
and developing a deep understanding of the businesses you're considering investing in.
Mm.
When you've done your homework
Yeah.
and you know the true value of a company, you're less likely to be swayed by the market's emotional swings.
So it's about having a solid foundation of knowledge and a long-term perspective to guide you through those turbulent times.
Exactly. Now, I know Buffett's approach may sound deceptively simple, but I imagine putting it into practice can be quite challenging.
Yeah.
Most of us don't have the time or resources to analyze companies the way he does.
That's a great point. It can feel a bit intimidating
It
to
can.
try to emulate someone like Buffett.
It's true. But the good news is that the core principles behind his approach
Okay.
can be adapted by anyone,
Mhm.
regardless of their experience or the size of their portfolio.
That's encouraging.
Mm.
So how can we, as everyday investors, apply Buffett's wisdom to our own decisions? Where do we even begin?
Well, for starters, we can focus on building a concentrated portfolio
Okay.
of high-quality businesses
Right.
that we truly understand.
Mm-hmm.
You don't need to own hundreds of stocks. A
Right.
handful of well-chosen companies
Yeah.
can provide ample diversification.
So quality over quantity, just like we talked about with Buffett's own portfolio.
Precisely. It's about finding those businesses that you're confident can stand the test of time.
Mm-hmm.
Those companies that you believe in. Now, another important thing we can do is make a habit of reading company annual reports, industry publications, other sources of information that can help us develop a deeper understanding
Right.
of the businesses we're considering.
Yeah.
It's about going beyond just the headlines
Mhm.
and really digging into the details.
It's about being an informed investor, not just someone who's chasing the latest stock tips
Exactly.
or trends.
But it's also about developing that long-term perspective,
Right.
recognizing that building wealth takes time and discipline.
Yeah.
It's not about trying to get rich quick.
Mm.
It's about patiently letting those great businesses compound our returns over time.
And that reminds me of something we touched on earlier, the importance of temperament.
Yes.
It's not just about intelligence
Right.
or analytical skills.
Mm.
There's a certain mindset that's essential for successful investing.
You're absolutely right.
Yeah.
Buffett himself has said that temperament is even more important than IQ
Wow.
when it comes to investing. It's about having the emotional discipline to stay calm when the market is volatile,
Yeah.
the patience to ride out those inevitable downturns,
Right.
and the humility to admit when you've made a mistake.
It's like having the mental fortitude of a marathon runner, knowing that you're in it for the long haul
That's a great analogy.
and that there will be ups and downs along the way.
And it highlights another important point.
Okay.
Investing isn't just about making money.
Mm.
It's also about aligning your financial decisions with your values and your goals.
That's a really interesting point. I hadn't thought about it that way before.
Yeah.
So it's not just about maximizing returns. It's about making choices that reflect who you are,
That's right.
what you believe in.
Exactly. And that brings us to something else that's quite inspiring about Buffett,
Okay.
his commitment to giving back.
Right.
He's pledged to donate the vast majority of his wealth to philanthropic causes,
Mm-hmm.
inspired by the belief that those who have been fortunate enough to accumulate wealth have a moral obligation to share it with those in need.
A powerful example of using wealth as a force for good in the world.
It is, and it speaks to the broader impact that Buffett's investment philosophy can have. It's not just about building personal wealth. It's
Mhm.
about using those resources to make a positive difference in the world.
Oh, that's something I think we can all get behind.
I agree, and it's a reminder that investing can be about much more than just maximizing our own financial returns.
Right.
It can be a way to contribute to a better future for ourselves,
Yeah.
our communities,
Yeah.
and the world as a whole.
Okay, so we've covered a lot of ground here, from Buffett's guiding principles
We had.
to his investment strategies, his psychological insights,
Yes.
and even his philanthropic endeavors.
He has big heart.
But there's one question that's been lingering in my mind this whole time.
Okay.
Can anyone truly replicate his success? I mean, he's Warren Buffett.
Right.
He's in a league of his own.
That's the million-dollar question, isn't it?
It is.
And honestly, the answer is probably not.
Yeah.
Buffett is a unique individual
Right.
with an incredible combination of talent, temperament,
Right.
and opportunity.
So it's not about trying to become the next Oracle of Omaha,
Right.
but rather about learning from his wisdom
Yeah.
and applying it to our own unique circumstances.
Exactly. We can learn from his discipline,
Mhm.
his patience,
Yeah.
his long-term perspective,
Right.
and his relentless focus on value.
Right.
We can adapt his strategies to fit our own risk tolerance,
Mm.
investment goals,
Yeah.
and time horizons.
So it's about finding what works for us as individuals, but using his insights as a guide.
Exactly. And that brings us back to something crucial, the importance of continuous learning and self-reflection.
Yeah.
Investing is a journey, not a destination.
I love that investing is a journey.
It really is.
Yeah.
And it's a journey where we're constantly seeking to improve our understanding of the markets, the businesses we invest in, and even our own psychological biases.
Right.
And Buffett's example is so inspiring because he's a lifelong learner himself.
He is.
You know, he's always seeking to expand his knowledge
Right.
and refine his approach.
He's living proof that even the greatest investors are always striving to get better.
He is. And he's a great reminder that we should never stop learning and growing as investors.
Okay, so we've really delved deep into the world of Warren Buffett, exploring his philosophy,
We have.
his strategies,
Yes.
and even his personality.
A little bit.
But before we wrap up this deep dive,
Mm.
I'd love to get your take on what you see as the most valuable takeaway from all of this.
That's a great question. And for me, it all boils down to this. Invest in what you understand.
Mm.
Don't chase fads.
Right.
Don't try to time the market.
Yeah.
And don't get caught up in all the hype.
Right.
Focus on finding those great businesses that you truly believe in. Those companies with a solid track record, a bright future, and a management team you can trust.
It sounds so simple,
It does.
but it's profound.
It is.
It's about cutting through all the noise and getting back to the fundamentals.
Exactly. Find those companies that you believe can weather any storm, and then hold on to them for the long haul, allowing the magic of compounding to work its wonders.
Yeah, it's about trusting your own judgment and having that patience to let those investments grow over time.
Exactly. It's about remembering that investing is a marathon, not a sprint.
Right.
And it's about finding those companies that you believe in, those companies that align with your values.
Speaking of aligning with values, I think it's really inspiring how Buffett has chosen to use his wealth to make a difference in the world through his incredible philanthropy.
Yeah.
It really adds another dimension to his legacy.
Absolutely. It shows that investing can be about more than just personal gain. It can be a powerful force for good.
Okay, so we've explored Buffett's philosophy in depth, from his investment strategies to his psychological insights and his philanthropic vision. But before we let our listeners go, I want to leave them with something to ponder, something that builds on everything we've discussed today. Is there a question that you think our listeners should ask themselves as they continue on their own investment journey?
That's a great idea. Here's a thought-provoking question.
Okay.
If you could only buy one stock today and hold it for the next 10 years, which company would it be and why? Really think through that decision, applying all the principles we've talked about today.
Right.
It can be a powerful exercise to help you solidify your understanding of Buffett's approach and identify those businesses that you believe are truly worth holding on to for the long haul.
That's a fantastic question. It really challenges you to think critically and strategically about what makes a business truly great and worthy of a long-term investment.
Exactly. And it's a question that can help guide you as you continue to learn and grow as an investor.
Well, on that note, I want to thank you, our listeners, for joining us on this deep dive into the world of Warren Buffett. We hope you've gained some valuable insights and are feeling inspired to approach your own investment decisions with a renewed sense of purpose and clarity.
It's been a pleasure sharing these insights with you. Remember, investing is a journey, not a destination. Embrace the process, stay curious, and never stop learning.
And until next time, happy investing.